The next piece of our conceptual framework has to do with what's called recognition and measurement. Okay, and so these terms are probably not familiar to you, and so you might want to pay a little extra attention with these ones. Okay, so we have general recognition we're going to look at. We're going to look specifically at revenue and expense recognition, and then we're going to look at bases of measurement, which is basically different ways to measure things. Okay, recognition, just so you know, you need to know this in this definition. It's the process of reporting an economic event into the financial statements. It's basically recording anything into the accounting information system. That's recognizing it. Anytime you put something into the accounting information system, you're doing, let's say, a journal entry, it's going to end up having an impact on one or more financial statements. Recognition can only take place when there's 4 criteria that are met. Number 1, key here, the item meets the definition of an element, right? So those elements, we had to define those first before we could say, now we can recognize it. That makes sense because let's say you're using cash and you're going to, buy something. You're going to have to put a debit in there. Well, you need to know whether that's an asset or is it an expense. So that's very important. We have to be able to recognize knowing the element that it is. Okay, these other 3, it's measurable. If you're going to do a journal entry, there's got to be a dollar amount that goes with it, right? So if you can't measure it, you can't recognize it in the financials. For those things that are not measurable but are really important, we can do footnote disclosures to talk about them. The last 2 go back to this thing. It's called whether they're reliable and relevant. And that went back to the old conceptual framework when the fundamental characteristics were relevance and reliability. In our new conceptual framework, relevance is still there, but we have faithful representation instead of reliability. And so the reason this is still using that old word reliable is because this part of the conceptual framework has not been updated yet. So when that is, they'll change that word to the item has faithful representation. But for now, we'll use the word relevance and reliability. So it's measurable, meets those fundamental characteristics, and it also meets the definition of an element. Okay, so that's recognition. We have 2 constraints. We talked about this already, but the cost-benefit constraint is there. We have to make sure that the recognizing it exceeds the cost of recognition. Okay, that it goes back to something we talked about with fundamental characteristics. The same with materiality. So you want to make sure that you're recording things that are material. And an example of something that might not meet the materiality threshold is you bought a bunch of recycling baskets that you're going to put in each of the offices of your building, and you want people to recycle. So you bought those little blue baskets with the triangle on them, and people are supposed to use them. Well, maybe that costs $200. If you recognize it as an asset, then you're going to have to depreciate it over its useful life. If you call it an expense, then you just go ahead and you put it in and you say, okay, some kind of supplies expense, let's say, and show the cash leaving. And the reason we can get away with doing that is because the materiality threshold says it's okay. So one way I describe the materiality is it's okay if we skip a little bit of gap because it doesn't really matter in the long run if we call it an expense or an asset. Okay, so that takes care of our general recognition. Now, specifically our revenue and expense recognition, we have a whole new chapter, but the old revenue recognition says in order to recognize it as a revenue, it has to be realized or realizable, meaning that we have cash, or an account receivable would be realizable, meaning that it's going to be turned into cash at some point. So the other part is that we've earned it. So we shouldn't call it revenue until both of those items are there. Turns out that we don't call it revenue until more than that happens, and that's in a later chapter because they revised the whole revenue recognition standards. So be familiar with the old one because it's an overriding kind of look at revenues, but we'll look more deeply at revenues in a later chapter. When it comes to expense, basically you want to you show the expenses in the period that it occurs, and you're using up economic benefits, right? Or whatever. So let's just look. There's 3 ways of doing it, 3 approaches to determine when to report the expense. One is you match it with revenues. So let's say you sold a computer and you have cash coming in. The cost of goods sold of that computer is recognized in the period that the revenue is recognized, right? So we match it with revenues. You expense in the period incurred. So this is a separate, different way. So the salaries and wages of the salespeople that are in our store, we actually just expense in the period incurred. Our third way of dealing with it is something called a systematic allocation, and it's over the periods of use. And so depreciation expense is an example. So suppose you have a fleet of trucks and you've got the assets and they're being used up over the 10-year period. Well, how do you show that as expense? To match it with revenues may cost an awful lot of money to try to figure that out, right? And it might not be easy to verify. How can you say that that much expense was used up in this year and a different amount in the year after? So the systematic allocation, basically, you think of straight line depreciation. We're just going to divvy up the cost of the truck over the 10-year period we use it. So the approach that we use, one of those 3 approaches, it depends on basically the type of the expense happening. Okay, this last piece, this is probably new to a lot of you. It's bases of measurement, right? So there's 5 different ways that we can measure things. Historical cost, you're familiar with. That's what you've been taught in the Principles of Accounting course. What did we pay for it? That's its cost. That's how we recognize it. That's how we measure it when we record it as a journal entry. This arm's length transaction, this will come back again, is that you don't want this to be between related parties. It has to be kind of like a decent arm's length transaction. Basically means that there's commercial substance in this. They're independent parties, and so you bargain it out and say, okay, what are we going to pay for that car? What are we going to pay for that truck? You bargain it out and you arrive at a cost, right? So now let's look at a couple different ways that we can measure things. Current cost is the amount of cash that we would have to, if we had to buy it now. So not what we paid for it before, what would we buy it now? So current cost. Current market value is the cash that we would get if we had to sell it now. Now look at those 2. They're a little bit different, right? Current replacement cost, we buy it now. Current market value, we sell it now. So it may sound very trivial, but they mean 2 different things. So those are both fair market value methods, those 2 methods, replacement cost or market value. Net realizable value is the amount that's going to be received. Take out any of the cost of disposal, right? So one thing to look at, and I know you've studied this before, is accounts receivable less the allowance for uncollectible accounts. So accounts receivable is listed on the balance sheet at net realizable value. We don't want to know the actual historical cost, what's on the books. We want that allowance for uncollectible accounts because that gives us a better estimate of what we're going to receive in cash. One final way that we can measure things is the present value of future cash flows. So using time value of money, we discount cash flows, and sometimes that's how we value certain liabilities, for example. All right, we'll learn more about that in the future, but that ends up with our 5 bases of accounting. That concludes our recognition and measurement parts.